Right, so it's Christmas Eve, and before we start the long holidays, I thought I'll do a quick market update so you guys know what's going on in the markets and you know what you can do as investors and as traders. So as I've taught in my programs and through my videos, you know that we are right now in a confirmed bear market because it is very clearly shown on the charts. In fact, I said this about a couple of weeks ago that we have over here, you can see from the 1st of November, we broke below the 200 moving average and it started sloping down, so that was the first signal of a downtrend. And then we had the 50 crossing below the 150 moving average, 50 sloping down, 150 sloping down. That's the second confirmation. So we are definitely in a bear market. We're definitely in a downtrend based on the charts. And you can see that since that happened, the S&P 500 has gone down very rapidly. It's like, you know, many days of selling in a row. All right, so what do you do in a time like that? So we know we're in a bear market, and in fact, if you have been reading the news for entertainment purposes, I always say that be careful when you read the news and always make your decisions based on the price action, never based on what experts say in these news articles, right? But it's interesting to take a look. So if you take a look at CNBC, which I always like to joke can never be correct, but I'm just kidding. It says, well, this just came out that, what is it over here? It says, yeah, so the latest charts declare a bear market, suggest correction will last another 6 months. And that's exactly what I said before. So you don't have to listen to all these things. If you just follow what I taught you, you'll be able to know a lot more, a lot faster than most of these so-called experts out there, right? And then it says over here, what does it say? This was today's news. It says the worst is yet to come. Ooh, experts say a global bear market is just getting started, right? Now, what do you think happens when most retail investors read these articles, right? That they say, oh, the worst is yet to come. The bear market is just getting started. Most of the retail investors would freak out, right? They'll call their broker. They say, sell now. It's going to get worse. You know, they say that it's going to be another 6 months. Let's get out now, right? And guess what? That's the worst thing that you can do. The worst thing you can do is to sell right now. Why? Because although we're in a bear market, remember price action. How do prices move? When prices move up or they move down, they never move in a straight line. They move in series of waves, right? So if you remember on an uptrend, it moves in a wave pattern, right? It goes up, comes down, goes up, comes down, goes up, comes down, right? The wave pattern. Remember, breathing out, you're going to breathe in before you breathe out again. Now, similarly, on a downtrend, right? Yes, we're in a bear market and we would probably go down for another couple more months. But will it go down in a straight line like that? No. How would it go down? In the same wave pattern. So after an impulsive wave down, guess what? You can't breathe out forever. You have to breathe in, and then breathe out. Breathe in, breathe out. Okay? So if you look at the chart right now, this is breathe out, breathe in, breathe out, breathe in. We call that the breathing out. So we call this the impulsive wave. So after a lot of selling, when you see a sharp drop in the price, guess what? This is the time when people panic, say, oh my God, it's dropped like crazy for the last few days. They read that article on CNBC saying it's going to get worse. What do most people do? Most people will, that's right, they will sell somewhere here because of fear, right? That plunge creates fear. And guess what's going to happen after they sell? Right? I'm going to bet you that in the next few days, I don't know exactly when, I can't predict the future, but could be today, could be the next few days, after they sell, it's going to rally up. That's right, it's going to breathe out first, right? And when it rallies out, they say, shit, you know, after I sell, you know, it goes all the way up. And they say, I'm going to buy it back. So they go, you know, or it may go all the way up to here. You'll probably go back to the moving averages, right? And guess what happens when it goes back up there? The news will say, hey, the market's recovering, right? And people will start buying there again. I'm going to buy, and what happens after that? Boom, it's going to go all the way down again. That's why the general public, the retail investors, always get fucked. They always get screwed by reading the news because they don't understand chart patterns, right? So even though that we are in a bear market, here's the thing, right? After a steep drop, I can tell you with high probability, in the next few days, it's going to do a bounce, okay? In fact, take a quick look at how prices behave during previous downtrends or bear markets, right? So if I scroll back, you can see that this was a very short-lived bear market, right? It slammed all the way down. And again, when something drops 90 degrees, it will tend to rebound very quickly up, right? Slams 90 degrees, rebounds up again, right? So nothing will drop straight forever. It will rebound up, right? If you scroll back even further, there's another example over here. So this was, again, a very, very short bear market, right? Slammed down, reversed up again. It goes down and reverse all the way up, okay? If you take a look at the major bear market, which was back in this one. This was the major bear market. Financial crisis, the market collapsed 55%. Now again, notice as it collapsed, it did not drop in a straight line. It went through again that wave pattern, right? So if you want to short or sell, always wait for a rally, right? You can see here, it drops 90 degrees. You can see that, 90 degrees. Again, doesn't go all the way down. It will rally and come down. Rally all the way up, and it will sucker in people to buy here and slam down. And it continues, right? So remember that before the market goes lower, it will rarely sucker buyers to come in and kill them. Sucker them, kill them. Sucker them in, kill them. Right? So that's how the market behaves. So never sell at the low, sell at a high. Okay? So the point is that, okay, here's the thing. If you are having an investment portfolio, all right, should you get out? Well, it depends, right? If you are holding lousy companies, crappy stocks, then you should get out. But don't again sell after a drop. Wait for a rally, wait for it to rally, right? Hit one of the moving averages and use that rally to sell some of your lousy stocks or weak stocks before the next plunge down, right? So always trim your long positions during a rally. Don't sell it during that thing, right? Now, what if you're holding great companies? Like in my investment portfolio, I'm holding some really good companies that are down. They went down because of emotions, all right? But in the long run, I know they're going to go higher, right? And I know that this bear market won't last for very long. It lasts for a couple of months. So for my good positions, good companies, I'm not selling them. I'm holding them, right? But I'm not adding on right now because again, I'm only going to add when, a couple months later when the bear market kind of like bottoms. Okay, so, but in the meantime, as it's going down, I'm actually shorting the market I can use put options, I can use inverse ETFs, I could short the S&P ETF. All right, and again, do I want to short over there? Do I want to short there? No, because you never short at the low. You always want to short during a rally, right? So I'm actually expecting it to go up, rally up, again, hit the moving average, and then I'm going to start shorting there again. By the way, when it started coming down over here, many of you who have been following my videos and following my emails, you know that I started shorting over here. And I shorted by put options, right? And after I shorted, it plunged and I made a lot of money, which I posted on Facebook. I showed you guys I made a lot of money. And what I did was, on the last trading day, which was on Friday, I took profits on my short positions. In other words, I exited my short positions and closed it for my profit. Okay, why? Because although I believe the bear market will last a few more months, but I know that after a steep drop, I'll take profits on my short positions. I wait for it to bounce up again, and then I short one more time, right? I do a short again, I sell the market, and profit as it collapses all the way down again, right? So always remember, on a downtrend, it's impulse, pullback, impulse, pullback, impulse, pullback. So always wait for a pullback to short the market or to sell lousy long positions. When it collapses, you can take profit over here, wait for the next rally, short it, and repeat that process, right? And never react based on the news that you see. Very, very important, okay? Now, I'm looking at the daily candles, but let me show you something interesting. If you zoom out and you look at like the weekly candles, and if you look at the last 10 or 20 year horizon, let me zoom it out for you. You may see something interesting that although this looks like a big crash, but if you actually zoom out from a longer term perspective in the last 10 years, notice that we are in a big channel over there, right? And we have been in this channel like that, over there. And currently we are right at that support of this channel. Okay, so far since the bear market started from the high, we've already dropped about 17%. About 17% from the high. Now remember what I've said in previous lessons, that a bear market usually drops 20% on average, to a major bear market even up to 60% during a major recession like the financial crisis, the dot-com crash, or the crash of 87. Now, I don't think that this bear market is going to lead to a major recession. Why? Because the economic fundamentals so far are strong. Employment is rising in the US, as well as ISM, manufacturing and non-manufacturing data is still strong. And in fact, the Federal Reserve just raised interest rates, even though people pressure them not to. Donald Trump told them not to raise interest rates, but they still raised interest rates because they said the economy is strong. All right, so I mean, they could be wrong, you never know. But the point is, the economy is still strong. So I don't think that this bear market is going to be a big one. It's not going to be a 50%, 60% bear market. I believe it's going to be like a 20% bear market or 25% bear market, which means that we've dropped 17%. We'll probably go down another, from here, maybe another 3 or 5%. Maybe somewhere here, we'll go down a bit more here. And then, boom, we're going to continue the next bull run, right? So again, as an investor, it's important not to freak out. If you're holding great companies, you can hold on to it, no worries about it, right? Could drop another 10, 20%. And the moment we start a new bull run, you have to ensure you're back into the market, or you have to add more shares if you can and ride the next bull run up. Remember, what goes down will always go up eventually if you hold good companies. So again, that's where the value momentum investing course comes in, that teaches you to use to do the fundamental analysis to only buy and hold good companies for investments. Now, of course, if you're a short-term trader, it's a different story. It's a short-term trader. Right now, the market's bearish. You should not be entering any long positions. All right. In fact, if anything, you should be holding short positions to quickly take some money by shorting in these short-term trends down. But I'm talking about investments over here. Now, you notice that in a bear market, even good companies producing good results will see their share price dropping massively, purely because of fear, irrational fear. So that is what gives us investors a fantastic opportunity to buy great companies at huge discounts. Companies that are still good, but are down purely on irrational fear that we should take advantage of, right? And I'll give you a few examples. So one example is, look at Federal Express. FedEx is a great company. It's got a sustainable competitive advantage, and in the long run, it will always go up. Now, what happened recently in FedEx? Let's take a look. Let me go to Federal Express, FDX. All right, so there we go. So FedEx was kind of like in a range, right? And you see this 90-degree drop, this parabolic drop in FedEx. And what really triggered that drop was, first of all, the whole market's bearish, right? The second thing was FedEx announced earnings. So were their earnings bad? No, in fact, they announced great earnings. They beat on top line and bottom line. In other words, their revenue and profit was more than expected, right? If you look at this article over here, it says, so the company beat expectations on both the top and bottom lines. FedEx reported earnings of $4 a share compared to expectations of $3.94 per share. It also beat expectations on revenue, right? Analysts expected 17.75 billion revenue, but they gave 17.8 billion. So can you imagine a company reports revenue and profits beyond expectations, but the stock price collapses? Why? Because the company lowered its future guidance, its forward estimate. So what this means is, the company said, yes, we did really well, we did better than what everyone expected, but we think next year will not be as good as you expect. Boom, the stock price collapsed. In fact, they lowered their future earnings by about 10%, right? This is over here. The logistics company lowered its full year 2019 guidance. Guidance means the forward next year's profits from 15.50 to 16.60 per share, down from 7.20 to 17.80 per share. Analysts expected 17.33. And that is what caused the massive sell down in that stock price. All right. So it goes to show you that stock prices are not driven by what's happening now. It's driven by what people expect in the future. So the stock price always moves ahead of where it is right now. Okay. So the question I'm going to ask is this: is it an overreaction? Well, in my mind, it is an overreaction because, first of all, FedEx is a cyclical stock. Cyclical means the price goes up and down, right? In fact, if you take a look at, let's take a look at a longer term chart. They show you the let me just load the moving averages here. Okay, something like that. Okay, so this is a longer term chart on FedEx, and you can see that, yeah, in the long run, it goes through these dips over here. So this was a recent drop over here. Now, FedEx, how much has it dropped since the top? Since the top, it has dropped about 36%. Okay, it's so far down 36% from the drop. And let me share with you an interesting way of analyzing how far the stock price can drop by looking at history, right? Now, let me show you a little bit of an analysis over here. That's right over here. Now, this is the historical drawdowns of FedEx stock price in the last 40 years, right? In the last 40 years. And you can see that, these were the years when FedEx dropped in price: 1978, 1980, 81, 84, 87, 97, so on and so forth, right? And you can see that the average time to hit the bottom was there. On average, I would say about 6 months, right, to hit the bottom of the drop, right? And on average, from the bottom, how long does it take to go back to the top? Well, there we are: 15 months, 6 months, 18 months, and so on and so forth. You can see that this was a major recession where it took 6 years to get back to the top, right? So in other words, if you bought at the top and it dropped, you have to wait 6 years to get back to break even. In this case, you have to wait 7 years to get back to break even. And that's why it's important as an investor, right? When it's dropping all the way down, right, you have to buy more at the bottom to lower your average cost. We call it dollar cost averaging, right? In order to average down. So when you have a lower cost base, you make your money back faster, right? But if you bought at the top and it dropped and you never bought it again because you were scared, you have to wait 6 years to get it back. But again, these are extreme scenarios in a major recession. But again, on an average bear market, which I think this is, you can see that on average it takes about 6 months to about 18 months, which is about 6 months to about 1.5 years to get back to the top, right? But I said, if you do dollar cost averaging, which means every 3 or 6 months you keep buying more shares, all right, you average your cost down, okay? So right now, FedEx is down 36%, and you can see the average drawdown for FedEx. Okay, these are of course extreme examples because of major recession, but during the normal bear markets, FedEx tends to drop about 40%. Drops 40% before it rebounds back. So we're down 36% right now. So again, if you base on historical drawdowns, okay, after this 36% drop, right, another maybe 4% drop, and it's going to go all the way back up again, right? Now, this is another way which I kind of like time my entries to know roughly where to get back in to catch the next wave up. Now, again, you should only do this on companies that are good businesses with solid sales and profits growing consistently. Don't do this on lousy companies, because lousy companies can drop and never come back. So the fundamentals have to be strong. And how do I check the fundamentals again? Again, I look at something like that. All right, I go to Morningstar, which I teach in my my lessons, in Wealth Academy and my online video lessons. If you take a look at FedEx, for example, right? If you look at their revenue growth, it's the last 10 years. Look at their revenue growth. Their revenue has been growing there consistently every single year. Well, not every single year, but it's a very clear uptrend in revenue, right? At the same time, you can see net income over here. Net income is also growing very nicely in an uptrend. So it's a solid company, growing sales, growing profits. And if you do an intrinsic value calculation, you can see that it is undervalued, right? It's an undervalued price right now. If you do a quick valuation on PEG ratio, you can see the PEG ratio is about 1.08. So based on PEG ratio, it is fairly valued. But if you use an intrinsic value calculation, looking at discounted cash flow, it is actually very undervalued, right? So FedEx is just one of the many examples of great companies selling at big discounts, and presents us investors the great opportunity to know when to get in, to make a lot of money when the bull run triggers, which will happen in a couple of months, right? But what goes down will always go up. Let me share with you another great company, which is BlackRock. BlackRock is the largest asset manager in the world. So most of the ETFs are created and managed by BlackRock. And again, if you take a look at BlackRock, it's a fundamentally very strong company, right? If you look at revenues, have been rising consistently over the last 10 years, all right? Net income has also been rising consistently over the last, not that, but this one, last 10 years. So great company. And again, if you do an intrinsic value calculation, which you have learned in a course, it is undervalued. All right, it is undervalued. If you take a look at the PEG ratio, from a PEG ratio perspective, it's about 1.23. So based on a PEG ratio perspective, it is reasonably priced. But again, based on cash flow, it is very undervalued. And again, if you take a look at the stock price of BlackRock, you can see that it's been sold down quite a bit, right? Since the bear market started, it's been down quite a bit, and it's right there at the 200 moving average based on the weekly candles, right? So again, these are one of the stocks which great opportunity to buy, undervalued. But again, wait for it to reverse to have some bullish price action, but not a good one. Now is Facebook. I've been talking about Facebook for quite a while, and I said it's a great company, it's undervalued, but it's still going down, right? So I have a position in Facebook, but I'm not adding more yet, right? Because again, I don't add when it's going down, because it can go down a lot more. Remember, in the short term, the market is emotional, it is irrational. Cheap can get cheaper, low can get lower. But if it's a good company, eventually you'll go higher. And I'll dare to bet my left leg or my right leg that you will go higher eventually, right? If you take a look at Facebook, there we go, right? It's been really bearish, okay, but it's really undervalued, and basically they're hit with all these bad news, right? They are getting sued, they've got this data leak scandal, and all the bad news is coming in, right? So, but what's the most important thing? The most important thing is, bottom line, are the number of users increasing? The daily active users, the monthly active users, is it increasing? Number one. Okay, number two, are businesses still advertising on Facebook? And I can tell you the answer is yes. Their daily users are rising, their monthly users are rising, and businesses are increasing their advertising expenditure with Facebook. And I can tell you that not just based on what I read, but my own personal experience. I mentioned this before, that my company, the Adam Khoo Learning Technologies Group, we spend over $1.5 million a year advertising on Facebook a year. And we are going to increase our advertising spending next year and the year after that. So if I'm spending more on advertising on Facebook, so are many, many other people. So it can only go up. Now, some people say, but you know what? How about people may jump to another social media platform? Where else can people go? Instagram? Well, that's owned by Facebook. Snapchat's for kids, right? And Snapchat's stock price is doing worse than Facebook. Twitter's more like a complementary thing, right? Twitter, it's still limited, right? The most important thing to look at is really looking at this, which is the daily active users. The more people that use Facebook, the more advertisers advertise, the more money they make, the company's stock price will always go up eventually. So again, really great company to look at for now, but I will inform you when I'm going to add on once I see some positive price action. And yes, active users in Europe have actually been flat. Where's Europe is, it's been flat. Okay, in the US and Canada, it's also been pretty flat, but the growth is coming from the rest of the world and from Asia Pacific. I am from Asia Pacific. I'm from Singapore, and I can tell you that in Asia, people are still using Facebook, and the numbers are increasing dramatically. Okay, so this little sharing about where the market's at. I'll do a more detailed one in the new year where I'm going to talk about the outlook for 2019. I hope that you found this interesting. Right? If you've got questions, send me an email. I look forward to seeing you guys again the next year. Merry Christmas. Have a happy holiday. Fantastic New Year ahead. And Adam Khoo, may the markets be with you. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.